Good morning, everyone. Welcome along to Wealth Coffee Chat. Got a few little technical difficulties this morning. My mouse is playing up, but anyway, welcome to another Wealth Coffee Chat, folks. Thankful Thursday. Good to have you here. Good to see a few of the early birds up and at it. Deb, always there. Fabulous. Kevin, early morning here, late evening there. Florida. Hey, morning, Tim and Donna. We've got Chris, Afshin, Nigel, Bryce. A few in the house. David, good morning. And there's Alex all the way from Cairns. Good to see you, folks. Great to have you on this morning. Hope you're well, wherever you are, whatever you're up to. Do the quick intros, as we always do. Jason Witten's my name. If you didn't already know, most of you do. But if you knew, if by chance, for some weird and wonderful reason, that you found us new or you're in our coaching and mentoring program, you've just joined, welcome. Fabulous to have you here. I've been property investing well over 20 years, done a few deals, helped a few people, many thousands actually. And along the way, learnt one or two things, maybe what not to do. That's important sometimes too, the things you shouldn't do. And then maybe some of the things that you should do. And each morning, get together with some passionate, crazy people just like you to maybe see if we can stay on track when it comes to our property investing. Try and work out what's real and what's not out there in the world of information, knowledge, media, madness. What's going on? So, welcome to the show. Good to have you here. Andy's, yeah, I think Andy's connected, Donna. I think Andy's connected his channels to my restream. So somehow that's happened. I might see if we can make sure that that doesn't confuse people. But thank you. I'm not Andy. I'm Jason. Hopefully, that's not too confusing for people. Hey, listen, what happened the other day? Tuesday, the first Tuesday of the month, the RBA got together with the I don't know, themselves or something, and they looked at what the cash rate was going to be and whether they were going to increase that cash rate, folks. And they didn't. They didn't increase the cash rate. They said we're going to leave it where it is, and that's great news. Good news for us as property investors. What does that mean? What does that mean to us? What can we take from it? Well, we all know that we've been sitting around for a little while waiting for, the finance world to get a little bit better. But there's some interesting things afoot out there in the world of finance that I thought we might talk about today. So that's the type of thing we might have a discussion on this morning. So tell me in the chat, folks, what are the things that we have been kind of, what are we as property investors been waiting for, or, things we can't by and large influence when it comes to the property market. So what have we been waiting for? And what has the RBA been waiting for? There's these two things kind of converging at the moment, and they're pretty important for us as investors when we want to get access to more leverage and money. What has been the kind of the standoff, the waiting thing? All right, number one, what have we been waiting for? Waiting for is kind of like is not necessarily a proactive thing, right? Yep, boom, dead right, Nigel. So number one, the RBA has been waiting for inflation, or wanting to see inflation slow down, right? And they have a target inflation rate of 2 to 3%. Okay, and Tim is on it as well. We want, and we as property investors, we want to see access to, finance improve. improve, because over those periods of time, two things had happened. The default, or the the consequence of inflation being high, the RBA acted and they put the cash rate up, which then flows on to us as property investors, interest rates, et cetera, et cetera, et cetera. And along the way, and it started a little bit before the inflation and cash rate rises, the buffer rate, the assessment rate for financing was put up to 3%. Now, if you think about what is on the radar in, let's say, the next 12 months, nobody is seeing that inflation is going to continue to rise. The information that's at hand for all of the investors out there, or those who are paying attention, and here's a bit of a chart. The inflation rate at the moment is tending to come down. Now, there's things called core inflation and headline inflation and all that sort of stuff. Now, I'm not going to dive into that today because, to be honest, that's not even my wheelhouse. That's something that Andy Fenton really knows a lot about. But what has happened, team? What has happened? Inflation gone up. Interest rates have gone up to slow that down, and we're seeing a turn. And this is kind of a prediction into the future. If and when inflation is back in this band, okay, so they're targeting, 2025, 2024, these years here, 25 to 27, what is Westpac also predicting, team? So into the future, Westpac was predicting that as well. So the things that we've been waiting for as investors, and waiting is because we had to, not because we wanted to, right? Because we've had to. We've had to wait for things to change a little for us to be unlocked for borrowing are now underway. So inflation is slowing. That's great, which means the RBA did not put it up. Okay, so they didn't put the cash rate up. I'm drawing and you can't even see what I'm drawing about. So inflation is slowing, and they didn't put the cash rate up, and access to finance is improving. And let's have a quick look at that one. So we've got a bit of a convergence coming, which I think, and we've been talking about it for a while, so it's nothing new, let's be honest, folks, when it comes to the world of investing, the world of finance. Most of us who are, patient, taking a longer term view of this, no, if you look in history, every single time we've had things, be great for a period of time, there's usually an adjustment afterwards. Things overshoot. Lowest interest rates ever in history, down in, 2%. That adjusts, inflation high, needs to adjust, etc. We know it doesn't last forever. This is the conversation I have with a lot of people. If you're behaving in the moment, if you're making decisions based about like, oh, my interest rate is 6%, oh no, and you're running around like a headless chook, then that's a very, I call that, very short-term thinking. And for us as investors, you should be behaving and making decisions based on owning that piece of real estate for 20, 30 years and what the long-term average would be. Sometimes it'll be a bit higher. Sometimes you're ahead. Sometimes you're, off the pace. Average it out. I know it's difficult sometimes when, the budget's being stretched, but in reality, like I said the other day, what's the priority? What's the priority for you? Do you want to build a property portfolio or not? If you do, sometimes you got to hunker down. Sometimes you got to sell a car to keep a property, not the other way around. And I've done that. I've done that heaps of times. I've sold things that are superfluous to continue to keep my property investment portfolio because that's the higher priority for me. Anyway, that's not what the conversation is about today. The conversation is about inflation slowing, RBA pausing for the moment. There's still a chance that they might, give it a little kick in the teeth in the next month or two, but let's see. And access to finance improving. What is that what does that mean? What are we seeing there? And let's talk about access to finance improving. And you guys have seen this little calculator. We use it for doing strategies for our clients and customers. And we talk about, okay, what happens here in the world of finance. Now, if you look over here, hopefully you can see this little section here where it says DTI, product rate, assessment rate, okay? This is where you can see what is going on when the lenders or brokers or financiers are calculating, right? A debt to income ratio, a 6.67. That's only just come in the last few years. But let's look at this. Even though you might be, they might be saying, yeah, I can afford to pay a 7% interest rate. What are they putting on top? All right. And we've talked about this before. Tim said it there. The assessment rate for financing. The assessment rate for financing is what has really caused us grief, because they're qualifying our finance, our lending at 9.8%. Now, if you were a person going, listen, which way do we think interest rates will go? And that's what the banks are talking about now. Which way do we think interest rates will go? We need to be attractive to attract business. Do we think interest rates are going to go to 9%? No, I don't think so. And why are we seeing that? What's going on out there in the world of finance? There's a couple of things. The other day we talked about this. The lenders are telegraphing, in certain ways that they think the interest rates will go down over the next 2 to 3 years. And they're showing that fixed interest rates, a 1 year and a 2 year fixed interest rate, is more expensive than a 3 year fixed interest rate. Okay. And what they're trying to do, folks, is lock in the cost of money on 3 year fixed interest rates at what at today looks like a lower interest rate for the future. But most of the lenders believe that within 2 years, the floating interest rate, the variable rate, will be lower than the fixed 3 year interest rate. All right. That's what that means. Anyway, that wasn't about today's chat. All right. So let's have a look at this. I've put in here Tommy Test. I've just put in, this is very simple. It's not very complicated, this scenario, but just to show you something that's going on. $150,000. We're looking, let's try and lend, $600,000, to buy a property. And over here is the capacity, max capacity, and the assessment rate. Okay. Now, what showed up in the calculator, which is pretty interesting, we've seen it happening a bit, is this additional information. Check out this. Apply special refinance assessment. Check policies here. Hey, here's a few that are doing it. Let's turn this button on. Watch over here, folks. Watch the max capacity borrowing, and then watch the assessment rate, okay, when we turn on this little button. So let's see what happens. That one's on. And, oh, look at that. Some of the lenders, see CBA up here, check it out, they dropped the assessment rate. Did you see that? The assessment rate there dropped 2%. Now, interesting, dropping the assessment rate, winning the refinance game, getting some cashback offers. There's a few out and about as well. Pretty interesting when it comes to this stuff. And if you go and have a look at the policies, this is where we find out what the fine print is on this one, right? That you still have to have a debt to income ratio that's low, and make sure you can afford the repayment. And then, have a look at the loan to value ratios. And in there, 80, 90%. So that's pretty cool. What does that mean to us? What does it mean to all of us right now, folks, when it comes to the world of finance? Well, makes me a little excited, to be honest. hopefully it makes you excited. Now, it might be boring and might be very inconsequential in the scheme of things. However, what does it mean? What does that mean to us right now? We've got a few things, right? Number one, inflation down, interest rates on pause, right? Into the future, the interest rates, because we've got some economic slowing, okay? Interest rates will go down. We know they will. And the cash rate will go down. Now, Westpac believes by 2025, the cash rate will be down a full 1%. All right? Full 1%. What does that mean to us? Okay, well, for some of us right now, we might look at a property, right? And it might be either neutral or negative cash flow, right? Some quality properties. And because the interest rates are 6s and 7%, and still the rents are growing, the rents are still growing, maybe that property is negative cash flow, 3-5 grand pre-tax, maybe even neutral or just a little bit positive after tax. But what I would say to all of you, if you're looking to purchase a property now and it might be a little negative cash flow, there's a couple of strategies you can deploy. All right. Sam coined this phrase the other day. If you have a look at the let's go 2022, 2023, 2024. And 2025, right? And so kind of interest rate like this. So if you go, oh, it's back. If you go, all right, interest rate, let's go 4%, 6%, 6%, 5%, okay? So the interest rate kind of like this, folks, as we go along. And Sam talked about this concept the other day, which was quite cool. It's like jump the hump. Right, jump the hump, folks. So right now you could deploy what's called an off-the-plan strategy, which is 2 years away, okay? Well priced, well bought, well positioned. You can buy it today, and then you can settle it when the interest rates are down. So this high interest rate world wouldn't apply. So that's one strategy you could do. You can still control and own the property. You can still control, you still own, but you don't have to pay for it in the higher interest rate regions, which is not too bad. Or you buy an existing property. You buy something today, existing, and at some point it might be a little bit negative, but when that interest rate comes down, your property will be positive, okay? Positive cash flow in the future. And I say that to all my clients all the time. When you do your cash flow calculations, don't only do your cash flow calculations based on today, right? Based on today. Mean reversion. You're dead right, Tim. It's a very simple conversation that most economic growth rates and things like that end up having some long-term average, and they go up or down in an average line. Anyway, I didn't explain that very well, but that's something that we could get Andy Fenton to do. Yeah, and it doesn't, yeah, you're dead right, Nigel. It doesn't take into consideration any of the other stuff that's going on, folks, right? Where we've got, massive population growth over the next 5 years. It's huge. It's massive. Like, it's the biggest population growth we've seen, immigration. It's going to unlock finance. There's going to be supply issues, suppliers constrained. So that's going to be good news for us as property investors if you own real estate. Not so great news for those who don't. You've got to be on the right side of the ledger to benefit from those supply and demand pressures. All right. And there's many other positive things Yeah, and it's not necessarily positive. It's good for our property prices and rents, but it's shit house for the real estate delivery and construction industry. But anyway, I think I'll leave that for another day. I'm always conflicted in this thought, this feeling where it comes to, the government has absolutely poleaxed the property construction industry with its stupidity and not understanding the ebb and flow of supply and demand. They don't give a shit about the small to medium builder, and even the larger builders. They don't care. So on the flip side of it, we benefit from supply being constrained, but I don't like it being constrained by, maniac friggin' politicians doing stupid stuff. Anyway, there you go. Mini rant over. Wealth Coffee Chat done and dusted, folks. That's it. Basically, hey, inflation's going down by the look of it. Cash rate paused. Awesome stuff. And early indications from some of the lenders that they are self-reducing the assessment rate to write loans. So exciting times. Time to crack on. Anyway, that's it, folks. Wealth Coffee Chat done and dusted. Thanks for joining me today. You guys know the drill. We got a saying around here: this thing's a marathon, not a sprint. It takes time. Do not make decisions based on really short-term, temporary things that are going on. And you should be able to navigate that very successfully, because if you are getting coaching and following what we have learnt to teach you, these moments in time, 12, 18 months of, higher interest rates should be very easily navigated because you've had buffers in place and blah, blah, blah. Anyway, if that's not the case, then you need that. If you want some coaching, let us know. Go and track down some of our coaches and ask them, hey, what do we do? What do we do? How do we do that? All right. Thanks, team. That's it. I'm done. You guys be good. Be well. Join me tomorrow. We'll have another chat. As always, if there's something that you would maybe like me to have a conversation about on the Wealth Coffee Chat, put it in the comment section and I'll track it down. All right, team. Adios. Be good. Take care. And bye for now.